Right, a really good afternoon. Welcome to this Share Tracking live webinar. Today we're talking about the topic of portfolio management. We're going to start the session in a few seconds as more of you are joining us. Warm welcome to those of you just joining us in the room. Always great to have you. Should you have any questions, as always, you're more than welcome to give us a contact, and I will provide you with the contact details at the end of the session where you can get a hold of us. Also, please do make note that we'll make this session available in our live webinar archive. So if you do miss it, that it is available to you. Right, so it's exactly 1 o'clock. Let's get going with the session. So today we're talking a little bit about portfolio management. Now, portfolio management is important, and the big question behind that is what is portfolio management? Now, it's normally an easy question to answer, and a lot of people would say, well, it's basically just managing your portfolio correctly. But there's a little bit of thought that does go into this, and let's just start out right from the beginning and then take it step for step as we move throughout this presentation about what's portfolio management. Well, first of all, portfolio management is the art and science of making decisions about certain investment mix and policies. It also looks at matching investments to the specific objectives that each and every individual has for their specific stocks, right, or portfolio, because every shareholder or every investor or share dealer has a certain amount of preferences that they have and what they search for within stocks, and they require their shares to do certain performances during a financial year. So matching investments to the objectives is important. Also, asset allocation, looking at where you're placing what and where you're investing a lot of your funds in. These can be different kind of things, investing into different sector groups, investing into different instruments, whichever the case may be. And last but not least, what's really important about portfolio management is the fact that we need to try and balance the risk against performance. We all know the saying that says high risk equals high reward, and that's fine. It's good to know that you have high risk, high reward, but the problem is the high risk end of it. Now, a lot of newcomers in the market would tend to risk a lot of money in the market, but then end up losing a lot of their funds because they did not balance the risk against performance, and they did not look at their objectives that their portfolio needed to attain. Now, it's really important with portfolio management to look at the strengths and to look at the weaknesses and also look at the opportunities and threats. Now, you're probably sitting thinking there, so you want me to do a SWOT analysis on my portfolio. And that's basically what you need to do. Because remember, investing into shares means that you're a part owner of a company, right? So if you're part owner, obviously you want to make sure that there are certain strengths within the company. You need to know the weaknesses of the company that you're investing into, but also you want to look at the opportunities and the threats that this company might undergo in the next few months or so. And a SWOT analysis is really important because if an economy like South Africa's goes into a recession, it has astronomical effects on certain shares. Also, when the rand is weakening or when the rand is strengthening, it will have an effect on rand hedging stocks. The same goes to say for commodity hedging stocks. If commodity prices goes up and companies benefit from that, then it's all good. But if it goes down, how are you acting based upon the information that you have? The same goes for if there's labor disputes between the laborers and the company itself over wage disputes and so forth. All these things have an impact on your shares. And it is a lot of information to take in, but it is really important. But all of these things that I've just mentioned are more or less external factors that you need to take into consideration. But there's always internal things that you also need to do a SWOT analysis on, and that's based upon the financials of the stock as well. But you can look at a few things, and I've just highlighted, let me just go one back there. I've highlighted a few, and you'll see you've got your debt versus equity. You can see whether or not the stock is just domestically listed or whether or not it's internationally, so it's a dually listed. And also you want to look at the comfort of growth versus the safety of buying into the stock. Obviously, high risk, high reward sounds good, but for a newcomer in the market, you'll tend to lose money because you're not investing into the right stocks. So high risk, high reward sounds good, but if you're not managing it right, it's going to cost you. And that's why we normally say some people need to pay more school fees than others. Now, if you look at the portfolio management styles, we know that we get different styles. Now, before I can answer the question of what sort of portfolio management style am I, that's the question that you need to ask yourself this afternoon is, which portfolio management style am I? Am I a trader or am I an investor? But before I can answer that question, I need to ask 3 more questions. And these 3 questions are as follows. What is my risk tolerance, right? What am I willing to risk? What can I endure? Because remember, investing into the stock market is an emotional thing. Once you invest real money in the market, you actually tend to get emotionally involved in the market. It's like getting married, right, to your shares. It has its ups and it has its downs. But the way you act is going to determine whether or not it's a success or not, right? And the same goes for the second question that you need to ask yourself, and what is my investment time frame? How long do you want to keep the particular stock that you're investing into? Is it a short, medium, or long-term stock? Obviously, at share tracking, we tend to teach you to keep shares for as long as possible due to the tax implications. And that's really important to note, because there are different tax implications for the different methods of trading. If you're a trader, you're going to most definitely be declared a share dealer. But if you're an investor, meaning you're keeping shares and taking dividends from those stocks over a longer period of time, then you will be regarded as an investor, right? And you'll only be paying normal capital gains taxes on those shares. And the third question that you ultimately also need to ask yourself is, what is the amount that I'm willing to invest? Now, if you're a newcomer to the market, if you're a novice in the stock market, and you've got 100,000 or 50,000 Rand available that you want to start investing, we wouldn't advise that you start off right immediately and invest 50,000 into the market. Rather start out with 10,000 or 15,000 or maybe even just 25 or 20,000, right? Half of what you have, so that you can get an idea of what sort of risk tolerance do you currently have. Because you'll tend to find that a lot of people say they've got their 50,000, they invest the whole 50,000, but after investing the 50,000, the share starts going in a other direction other than going up, right? And then they start freaking out and then just start selling the stock. And it's not the right time to sell it because the share's probably only just busy with the correction. But you're so emotionally involved, over-involved in your portfolio that you're selling your shares at the wrong time. And money will do this to you. The more funds you invest, the higher your risk tolerance needs to be. You're going to need to learn the emotional involvement that is required when investing on the stock market. So rather start with a smaller amount and build your confidence as time progresses. Now, there are different sort of investors. First of all, you get your passive investors. Now, passive investor, you'll see I said it's a long-term, has a long-term perspective of their portfolios and only expect good returns over the longer period. Now, these sort of investors would commonly tend to invest into high-quality blue-chip shares. Now, the reason why we say high-quality blue-chip shares is because history has shown to us that high-quality blue-chip shares tend to double in value every 5 years. Now, that's actually really good. Your investment doubling in 5 years. That's really great. Now, what are blue-chip shares? Well, remember, blue-chip shares are very large, very safe, well-known companies with a really good extended track record of good rising in earnings and excellent management over the years. We also need to take into consideration, if we look at the fundamentals of how do we perceive that a stock is a good quality blue chip stock is, that we need to bear in mind that good quality blue chip shares generally trade on a dividend yield of around 2.5%. Then we know it's in favor, it's in a normal market. But if we find a good quality blue chip share that for some odd reason is trading in the region of a dividend yield of about 5%, then that is a good indication that we might see that share as being out of favor with the major institutions, meaning that the bigger companies, the insurance companies, the unit trust firms, the pension funds, they don't like the share at this point in time, so they're not backing it. Remember, about 90%, 80 to about 90% of all shares traded on the market is owned through the big major institutional companies. Only 10%, plus minus, is owned through private individuals. So obviously we want to know whether or not a stock is in favor or out of favor with the major institutions. Now the next sort of style that you can be is obviously being a trader or being actively involved in your portfolio, right, on a day-to-day, hour-to-hour, minute-to-minute basis. Now, someone like this would generally buy shares that tend to have very high amounts of volatility combined with higher risk-return ratios. So people that would tend to be active traders are people that are searching for stocks which are not too expensive, but which they can buy and sell on the same day and make a quick buck off of it. Now, if we talk about volatility, you need to understand that high volatile shares move up and downwards radically over a very short period of time. Now, a good way to get an idea of how volatile a share is by looking at the beta value of the stock. Now, you should know this by now. If you've been joining us for the last few months or so, we've been talking about this quite a lot, and we've mentioned that in our charting tool, the share tracking charting tool, you've got an indicator called the beta, B-E-T-A. Now, the beta value tells you a little bit about the volatility of the stock. Now, if a company has a beta value of anything more than 1, we would tend to say that it's a little bit more volatile than a company that has a beta value of less than 1. Now, what does it mean when a company has a beta value of, let's say, 1.5? Let's take an example. FirstRand currently has a beta value of about 1.5, for instance. Now, that means that if the financial sector index goes up by 1%, if the market just moves up by 1%, that FirstRand itself will move up by 1.5%. But then you get other companies which only has a beta value of 0.3 or 0.5. That means that if the market moves up by 1%, that company will only move up by about 0.5%. Now, those are really interesting things to bear in mind, because if you are someone that has a very low risk tolerance, then you need to look at stocks which has very low beta values. Because if you're going to start investing into stocks that has very high beta values, you're going to be thrown all over the place and your emotions are not going to be in check, right? We just said that once you start investing your real money, we see that the emotional side of things start getting involved in it, and this normally has a huge effect on the outcome of your performance. Now, I want to reiterate this by saying that share tracking encourages every person to be more of a passive buying or a long-term investor, to keep the shares for as long as possible, normally between 3 to 5 years. Now, as a beginner in the market, I did say that trading actively will in most cases lead to massive amounts of losses in funds due to poor timing and selection of shares. Now, this is a really good thing to remember. You need to bear this in mind, that even though the passive approach will take you a little bit longer than what the active trading will take you, you need to bear in mind the risk that is involved in buying and selling the whole time, and also the tax implications that is involved when buying and selling the whole time. All of these factors need to be beared in mind before making decisions. Now, yes, there are some few key elements that we need to focus on, and the key elements that is really important in managing your portfolio is as follows. The first one is looking at asset allocation, right? The asset allocation. Now, asset allocation looks at a few things. Now, first of all, I'm going to put everything for you on the board. The first one we mentioned there is the key to effective portfolio management is looking at more of a long-term mix of assets. So you're going to look at good quality stocks that you can buy, but keeping them for the long haul. Also remember that asset allocation is based on the understanding that there are different types of assets and all of them don't move in the same speed or move at the same pace as the other one does. The reason for that is that some shares are just more volatile than others. We just said that. Looking at the volatility of the stock, the beta value of the stock is a clear indication of the sort of movements that is involved within that particular share. Now, we need to bear in mind that asset allocation seeks to optimize the risk to return ratio for your profile or for your portfolio. Now, if you are an investor, obviously you're going to invest into stocks which are very low risk and has low correlation with each other. So you're going to invest into different sector groups within stocks that are not that high risk. But investors who are a little bit more aggressive, they would tend to look at more volatile stocks, right? Looking at shares that has very high beta values. So looking at more high risk, high return sort of stocks. And these things might include financial stocks that has very high beta values, maybe some mining shares, maybe some industrial stocks, whichever the case may be. You would tend to look at those things. But if you are really more conservative, it is advisable that you would tend to weigh your portfolio more towards stable stocks. So shares that has beta values of less than 1 or so, and that also has a really good management style and really good financials behind it as well. Now, this is the first key element that we need to look at, asset allocation. The next one that we want to look at is diversification. Now, diversification focuses on the following. That there's only the only certainty in investing is that it's impossible to constantly predict the winners. We get this a lot. A lot of people say, okay, but do you have a win-win ratio of about 90 to 100%? And that's purely impossible. Currently on our winning shares list, the shares that we put onto our winning shares list, about 7 out of every 10 shares move up. So about 3 of them you will need to use, you should have implemented a very good stop loss and you would have been knocked out of the market, but at least 7 of them would still show you good signs of growth. So we have about a 70% hit ratio on it. It's impossible to get 100. It's purely impossible. There's too many factors to be considered when selecting the right stocks. Now, the next thing about diversification, which is really important, a really important part in your portfolio management, is the fact that diversification spreads the risk over a bunch of stocks. Now, if you buy one share, all of the risk is just on that one stock. But by the time you get to 4 shares, you only have about 25% risk per share. By the time you get to 8 shares, you're only sitting at about 12.5% risk per share. So you can clearly see the more diversified you are, the better. Now, please do bear in mind that diversification does not mean buying shares in the same sector group. Now, if I say that, you need to bear in mind also that I'm not just saying financial stocks is a sector, oil and gas is a sector, industrial is a sector, consumer goods is a sector. But within those sector groups, you'll see that there are different sub-sector groups. For instance, it's fine if you buy, let's say, Break shares, which is an investment firm, and then you buy FirstRand shares because FirstRand is in the banking sector. So they're basically both of them in the financial sector, but they are in different industries, right? And those things also carries forth some form of diversification. So that's also something that you might want to do. So it's not always to say that you need to buy one share in financials, one in industrial, one in consumer goods, and so forth and so forth, because there are different subgroups available. Now, if you don't know where to go and get that or look at the different subgroups, those subgroups are available to you, and you can actually go and get those subgroups. You'll see under your subscribers area, you've got an equities list, a JSE equities list, and under that JSE equities list, you can go and look at all the sub-sector groups below the main sector heading. Now, also remember that proper diversification takes place across different classes of securities, sector groups of the economy and geographical regions. And just basically to say that you can invest into normal equity stocks and then expand your portfolio as you gain more knowledge into different sorts of things that are available for you to invest into. Rebalancing is really important. Rebalancing almost always entails the sale of your high-priced, low-valued securities and the redeployment of your proceeds into low-priced, high-value or out-of-favor securities. So what it basically says is you need to make sure that you are balancing your portfolio. If the time comes where you need to sell your good quality stocks, you need to do that, and you need to reinvest your funds into shares which are undervalued but still of high quality. You'll see we say low priced, high value. You sell the shares which are high priced and low in value to buy shares which are cheap but very high in value. Now, there are a few ways to look at your portfolio. Now, let's look at the different things that you can look at, the way you can look at your portfolio. First of all, don't just think of your portfolio as like it's just a portfolio. Think of it as a group of companies that you own, and each one of the companies that you own is trying to give you the best returns that it possibly can. Remember, you are in control of your timing and selection, so you determine when you're getting into that stock. The second view that you should have about your portfolio is having standards. Now, this is really important. You need to have standards. Filter out for quality. Use the share filter which is available to you in order to filter out for good quality shares that fall within your ambit, right, or within your preferences. Now, this will improve your performance because you will eliminate the less good quality stocks, so the shares that are underperforming, and you want to try and filter out for any shares that has weak balance sheets, for instance, or poor earning trends, or low or falling equity, long-term share price downward trends, so shares that are in bear trends, bad management styles, and unreliable dividend trends. So companies like that you want to eliminate. Now, as I said, this might sound a lot daunting if you want to try and filter out for them, but remember, this is all part of your fundamental homework. You need to use the share filter to filter out for the shares that fall within your preferences but are still considered to be high quality stocks. The next one is trying to attempt to get your timing right. Now, I'm saying attempt to get your timing right because it's impossible to get it exactly 100% right, but you want to get as close as possible to it. Now, remember, when you're looking at the graph of a particular stock, remember, it's not just the line on the graph. It's every investor's perception of that particular stock shown to you on a graph. So everybody's perception on that share is shown to you with that line that is drawn on that chart. You need to try and determine if it's the right time to get in. Remember, make use of your technical analysis, make use of your moving averages, your indicators, in order to try and discern whether or not it's the right time to get in or whether or not it's the right time to get out. This one is probably one of the more important ones. You need to have constant vigilance and discipline. You have to react to things that you find out. You cannot act if you've read a news article which is not good and it's going to have a negative effect on your shares. You can't wait till the end of the month before making any decision on whether or not you're going to get out of the stock, or whether or not you read some good news and then you try and determine, okay, but I'm only going to buy it at the end of the month. You need to act immediately. I normally say if you're an investor, you at least need to look at your portfolio once a day. And you can do that just before you go to bed. Open up your portfolio, look at what happened in the markets, and then get back to bed, right? It's really important that you have constant vigilance and discipline over your portfolio. Remember, you want to sell the losers and look at your gainers. So those shares that are underperforming, make sure that you have a strict stop loss in place in order to get rid of them if they continue with their negative performance. And remember, you want to still keep into those good quality shares because we are investors. So we're keeping the good quality shares for as long as possible. The next one is works exactly in conjunction with what I just said with point number 4. Let your profits run. If you've got good quality shares and you've removed the bad shares, Let your profits run. I normally say if the gravy train keeps going, I will stay on the gravy train. I will only get off as soon as I get an idea that, or a feeling that the gravy train is busy slowing down. So remember that. The next one is not something that a lot of people do, but it's just something interesting that some of the more experienced investors tend to do, and they call it pyramid up. Now, pyramid up means you are constantly selling your low-valued stocks, right? So the shares which are not performing, getting rid of them, and buying more shares of the ones that are performing. So if you have some first-round shares which are doing well, you might want to tend to buy some more. And that's called pyramid up, getting rid of the bad quality stocks and getting into the good quality shares. Now, all in all, to summarize this session, we looked at a few things which is really important, and these are the things that are really important for me in a portfolio management style that you need to have. First of all, you need to filter for quality. Remove the shares which are not performing. If the share is not performing, get rid of it. It's not worth your while. Make use of strict stop losses. In our webinars and in our lecture modules, we constantly reiterate this. You need to filter for quality. You need to apply a strict stop loss. Get out of the stocks which are not performing. Invest in the companies that's making you money. The next one is identify high quality blue chip shares. High quality blue chip shares, we said, when they're in favor, will normally trade on a dividend yield of about 2.5%. But how do you know if it's out of favor with the major institutions? Well, quite simple. If it's trading in a dividend yield of about 5%, then we know it's out of favor with the major institutions, which is quite interesting. The next thing which is really important to notice, you need to do a proper technical analysis. If you do a proper technical analysis, this will help you to improve your timing. Timing is one of the key things that a lot of beginner investors tend to get wrong. Selection, not so much, because when you're starting in the market, you'll tend to focus on companies that you know, which will normally be high quality blue chip shares. But if you're buying shares at the wrong time, it doesn't help you buying high quality blue chip shares, but you're paying too much for it. So remember, practice your timing. Get your timing right. The next one is employing vigilance. Look at your portfolio. Never neglect to look at your portfolio. Remember, it's always your funds. You need to be aware of what's happening with your portfolio. I'm not saying you need to sit in front of your screen every minute of every day, but at least watch your portfolio once per day to get a good understanding of what's happening to your stocks and what's happening in your overall portfolio. And last but not least, be disciplined about the loss makers and let the winners run, or let the winners just make you more money. And this is important. I just said that. You need to get rid of the shares which are not performing and get into the stocks which is making you money and take good dividends from them. This is why it's so important to make use of a stop loss. Now, I hope you found this session interesting and then you've got a better understanding of portfolio management. If you have any questions, please do not hesitate to phone us immediately on 012-940-0800. Just that number again for you, 012-940-0800. Remember to register for this week's webinars. We've got webinars running all the way to up until Friday. So please do remember to register for this week's webinars as well. All of them starting at 1 o'clock. Enjoy the rest of your week. Bye-bye.